Investors, turn on the TV and financial news channels. Watch for a few hours and soak in the opinions being passed along as news. You too will convince yourself that a terrible recession is imminent. Geopolitical strife domestically and globally. Bank runs in Europe and regional bank runs here in the US. And the kicker is still rampant inflation if one listens to the parade of Ph.D. economists and sell-side strategists on the financial channels or writing in newsletters. I've been managing money professionally now for almost 30 years. I've never heard so many people so uniformly negative and confident in their economic opinions of the forthcoming doom. Ignore the facts that almost all of them have been wrong on the markets the last 9 months and missed calling the recession we had in the first half of 2022. Ignore that many of these same people have been calling for a recession to begin in late 2022 since mid last year. It's May 2023 and we're still waiting. Recession in the first half of 2022? Chris, what in the world are you talking about, you may ask? Well, I was taught early in my career that 2 consecutive quarters of negative real GDP growth was a recession. Pretty simple. No after-the-fact stamp of approval needed by a group of economists employed in taxpayer-funded buildings. No waiting around for 3 or 4 quarters to find out. And during the typical recession, stocks usually decline minus 25 to minus 35%. So what happened in the first half of 2022 as we printed 2 negative quarters of GDP growth? The S&P 500 dropped minus 25% in nominal terms and almost minus 35% in real terms in the summer of 2022. Remember, viewers, that the NBER, National Bureau of Economic Research, declared our economic collapse during the second and third quarters of 2020 as a recession in July of 2021, almost a year after the event. You want to wait around for them? Investors, trying to predict the beginning and ending of recessions is almost always as difficult and generally a waste of time as trying to trade government data as it crosses the headlines. Investors, inflation is coming down fast. I know economists like to quote the government CPI data. I like to take my cues from the market. Here's a chart of the 10-year inflation break-evens. This is the 10-year nominal Treasury yield minus the 10-year real rate. This is what the market is pricing in for inflation down the road. It's dropped from a peak of 3% in early first quarter of 2022 when the Fed started raising rates to about 2.25% today, right at the top of the range that existed for almost a decade pre-COVID. More interesting is the chart of the shorter-term 2-year break-even inflation rate. This measure rose from an average of about 1.5% and a range of 0 to 2.75% pre-COVID decade to a peak of almost 5% in the second quarter of 2022. Here's that chart. As you can see, since mid-2022, when the Fed started accelerating its rate increases, this measure of inflation expectations has headed down fast. It now sits at just over 2%, not far from the Fed's goal. Lower trending inflation is good, not bad for your money. What is the market seeing that isn't being presented to you on TV with many dire predictions for inflation in the economy? That for almost 2 years, the cumulative reported inflation data has actually been decelerating versus economic forecasts. Here's a graph of the Citi Inflation Surprise Index that represents the sum of the difference between the official economic results and the economist's forecasts. This index led the CPI higher by 10 to 12 months in 2020 post-COVID reopening. It then peaked in August of 2021, almost the same 10 to 12 months in front of the CPI peaking in June of 2022, and it's now negative. This, combined with a historically symmetrical rise and decline of CPI we previously discussed in past cycles, puts the market on course for more often than not better inflation data, not worse, throughout the rest of 2023. Remember, investors, stocks move around marginal improvements or marginal declines. Are things getting better or worse at the margin? Around the topic of inflation, things are clearly getting better for consumers. And while we aren't currently there, Goldilocks for stocks has been consistently boring economic growth of 3 to 5%, made up of a combination of 1.5 to 2.5% inflation and 1.5 to 2.5% of real growth. Take a look at the weekly chart of the S&P 500. No, I'm not a chartered financial technician, but with each passing week, this pattern continues to look more and more like a reverse head and shoulders bottoming pattern, regardless of economic prognostications on TV. Looking at the monthly S&P 500 chart, I can't find an example of this pattern in the last 20 years that isn't bullish. Does lower trending inflation or a neat-looking pattern on a stock chart mean that for the rest of 2023, it'll be a straight line up for equities? No, of course not. And while, as we discussed last week, volatility markets argue for a strong May and early June, which is in line with our first half 2023 market forecast, they also portend a very normal summer sell-off. Investors, when the economists and strategists on TV start talking uniformly about recessions or chronic inflation, try as much as you can to walk away and take a deep breath. The consensus is almost never correct. And when it comes to asset allocation changes for our clients, most of the time, the best action is no action, as this allocation was presumably set with a multi-year time horizon. The best time to make changes to your asset allocation is when your emotions in market volatility is low. Investors, there is no perfect investment philosophy, and there is no perfect market trading tool that's all weather, outperforming every stock market cycle or every economic environment. At Oak Harvest, we have many tools, both market and insurance-based, that our advisors use to help our clients meet their retirement goals and objectives. The future and the stock markets are always uncertain. That's why our retirement planning teams plan for your retirement needs first and your greed second. Give us a call to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. For myself and the whole team here at Oak Harvest, have a blessed weekend.